In every aspect of life, one tries to go where outlook is best, be it looking for a job, or build a factory in an area, or going to the school, or even going to a restaurant. But in investing, according to Sir John Templeton, one should actually do the opposite. His principle was to invest at the point of maximum pessimism. He invested during the World War II, after the Black Monday crash of 1987, and even after the 9/11 terrorist attack. His philosophy was to invest in situations where the problem was temporary. He always believed that the reason a stock is being offered at a bargain price is because other people are selling. There is no other reason. To get a bargain, you have to look where public is most frightened and pessimistic. He was a true value investor and would always look for bargains. But what actually is a bargain? Let's find out. Bargain hunting. Let's consider two Indian companies. First is Reliance Industries Limited, a very popular one, a behemoth in oil refining, retailing, and cellular data provider. And second is GIC Housing Finance, a housing finance company with small market cap and hardly known by a lot of people. Reliance Industries has a market capitalization of 18,543 billion Indian rupees and it earns a profit of 741 billion, whereas the market capitalization of GIC Housing Finance is 10.37 billion rupees with a profit of rupees 2.13 billion. Comparing market capitalization to profit of both the companies, which is also known as the PE ratio, which one looks a bargain? You guessed it right. It's GIC Housing Finance. Buying a company which is 25 times to earnings doesn't look cheap, but buying a company with mere 4.86 times earnings does. The idea behind a bargain is not to be totally a contrarian, but rather a wise buyer of out of favor stocks. Having the wise information of out of favor stocks and buying when the stock falls in price is called bargain hunting. But is there any one way to judge a bargain? According to Sir John Templeton, there are 100 yardsticks to measure a bargain. Here are a few of them. Price to earning ratio. In the above example, we have discussed regarding this. The lower the ratio, the better the bargain. Price to book ratio. Considering the example of GIC Housing Finance, let's look at its balance sheet. Equity value of the company is total assets minus total liability. Book value per share, equity value of the company divided by the total number of shares. GIC has 53.85 million shares. Therefore, book value per share 327 rupees per share. If price of company in stock market is below 327, then one can assume that on the basis of price to book, it is a bargain. Corporate takeovers. If one company in an industry tries to take over its competitor, then one must reach to a conclusion that the company being takeover is undervalued. Competitors know more about the companies in the same industry. They know what potential lies ahead and what probable profits the acquired company can make. Enterprise value to EBITDA. Enterprise value of a company is the value of company in equity market, which is also called market cap, plus total debt the company has in its balance sheet minus cash. EBITDA is earnings before interest, depreciation, tax, and amortization. It is similar to the price to earning ratio, but it takes into account the debt of a company. The lower the enterprise value to EBITDA, the cheaper the value of the company in the market. Companies buying its own shares. If companies are buying their own shares from the market, then it's a very good sign to conclude that one company's share is at a bargain. Who else would know better? If lots of institutions and insurance companies and foreign investors are holding a lots of cash, then it can be assumed that stock prices are depressed. This money, if put to work, may move the prices in higher direction. Global investing. Why should one go for global investing? If you can select from 20,000 stocks instead of 3,000 stocks to find a bargain, wouldn't that be better? What about if people think Indian companies lack credibility, or Taiwan may be attacked by China someday, or I don't understand the accounting language of certain country? Cliches like this may create more bargains. Global investing may also give you the benefit of diversification. One should also think in terms of opportunity cost, which means that every action we take, we give up the benefits of taking an alternate action. If you had invested in United States Dow Jones Industrial Average in the year 1969 and stayed put till 1979 for a complete decade, what do you think your return would have been? 10% CAGR? 12% CAGR? Nah, zero. What? Yeah, zero. From 1969 till 1979, Dow Jones oscillated between 865 points to 1000 points, but ending the decade at 875, literally providing zero returns. Had you invested in Japan in Topix Index in 1969 till the year 1979, your compounded return would have been 13% CAGR. This is when opportunity cost comes into play. One should not lose the opportunity to earn better returns. But before looking at a specific country, one should look at the individual companies first, not the other way around. Factors to consider before selecting a country. What if someone asks you to invest in Pakistan and assures you that you are getting bargains there? What would you do? According to Sir John Templeton, one should look at the external borrowing to GDP ratio of the country, and one should not invest if it is greater than 25%. One should also consider high saving rates of its citizens. A mid 20s is considered a good savings rate. Does a country promotes free enterprise and freedom of individuals to pursue their interest? One should avoid countries where practices and policies are trending towards socialism. Pakistan does not fare well in any of these conditions. I would rather not invest. Pakistan's currency may devalue itself, offsetting all the bargain gains for me. Pakistan's military also has the right to transfer ownership to them. It is a complete no for me at least. Bonds as investments. We all know bonds have two components. First is principal and other is the interest rate, or also called the coupon rate. The issuer of the bond receives the principal amount and in return pays the interest to the investor in addition to the original principal. The interest part of the bond consists of three built-in components. If US government rate is 3%, then the investor expects return of at least 2 to 3 basis points above the government rate to offset his risk. What about inflation? If an investor expects to hold a bond for 5, 10, or 15 years, then he would like the inflation to be offset in his returns. The value of $100 will not be same as $100 in 5 years. It will have a lesser value due to inflation. What about default of the issuer? Should not the risk of default be included in the expected return to the investor? Definitely, it should. So, three components: US government rate, inflation, and the risk of default are built in components of this bond. If you can figure out the movement in US government rate, which will be only a few times in your whole career of investing, then you can figure the inflation. Low interest rate environment gives birth to higher inflation, and in turn an investor expects a higher return in bond. Therefore, bond price and interest rates move in opposite direction. Figuring this one can invest in bonds and then bonds will not be boring. Let's recap. Invest at the point of maximum pessimism and you will get a bargain. There can be number of ways to judge a bargain. You can use any yardstick. Considering global investing can be a good idea. Bonds are sometimes not boring. Cheers, guys.